Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Welcome to this episode of Through the Noise. My name is Heung, Senior Investment Strategist with the CIO Office. With me today is my colleague, Fook Hien, also a Senior Investment Strategist within our CIO Office. Fook Hien, last week we continued to see headlines coming from the US, in particular on the political front. And our weekly reports actually talks about the impact of political upsets and potential trade tariff legal setbacks in the US. Can you give us an overview of what has happened and what are the investment implications for this?
Yeah, sure, Ray. So the Democrats' election surge likely imply the end of the government shutdown in the US. Now, the US government shutdown, it has entered a record sixth week. And although markets have largely ignored it so far, it is starting to make its impact on US politics. So New York City elected a Democratic socialist as its first ever Muslim mayor. And meanwhile, Democrats won the race for governor of Virginia, which is home to hundreds of thousands of federal government workers. And they are flipping the seat from Republican control there. And they retained the governor's seat for New Jersey as well, among wide-ranging gains in local government elections across the country. So President Trump, he's blamed the Republican Party's electoral upsets on the government shutdown. So this raises the odds of a deal with Democrats to end the impasse. A deal would likely involve the extension of healthcare subsidies under Obamacare, which are due to expire by the end of the year. Then in terms of legal setbacks, there is a question of whether we see a rollback in the US tariffs. The US Supreme Court has started examining the legality of Trump's tariffs following a challenge from US businesses and states. Although a decision could be months away, markets are parsing the tenor of initial questions to assess the court's leaning. The focus is whether the president's use of the 1977 International Emergency Economic Powers Act to impose these import tariffs, whether it violates the constitutional authority of the Congress to impose taxes on Americans. So during initial arguments, both conservative and liberal judges, they appeared skeptical about the administration's authority to impose tariffs, and hence this is raising the odds of a rollback of the duties. Three lower courts, including a trade court, have already ruled against the administration. So in terms of investment implications and where the market is today, the US equity investor positioning is bullish, and there are concerns about elevated valuations, which could lead to a 5 to 10% brief pullback in equities. However, the US politics and the courts, they could provide the next catalyst for a year-end rally. The Republican Party's losses in local government polls this week, it should spur the party to agree with the Democrats to end the government shutdown. Meanwhile, the US Supreme Court in the opening questions appears to be skeptical about the legality of Trump's tariffs. So a deal to end the US government shutdown and a potential rollback of US tariffs by the top court would be positive for risk assets into year-end.
Thank you, Fook Hien. Let's look at the US equity a little bit more in detail then. A lot of the strength has been driven by the technology sector. Is an overweight on the technology sector still justified after mixed reaction to the AI companies' recent earnings?
Yeah, we maintain an overweight on the US technology sector. And in fact, we initiate an opportunistic idea on the sector in the current pullback. If we look at the Q3 earnings season, it has been strong. Overall, for the companies in the S&P 500 index that have reported, they're delivering a 10.4% positive earnings surprise, according to LSEG IBIS. Within this, the technology sector has seen an 8.5% earnings surprise, beating the already high expectations. Technology is delivering the strongest earnings growth in Q3 of 28.5% year on year. The stock price behavior suggests that markets are rewarding companies with a growth acceleration, such as those in cloud services, from AI demand, while the market is not favoring companies with accelerating capex without a visibility in orders and business pipelines. However, the fundamental picture for the US technology sector remains constructive, and the Fed rate cuts should help soothe valuation concerns. Technology's earnings growth in 2025 and 2026 has been revised higher steadily throughout the year, with the broadening of AI investments and increasing demand. We expect the strong earnings growth at 23.5% in 2025 and 22.8% in 2026, and this would support the sector's outperformance over the next 6 to 12 months.
Let's stay in the equity and turning to East. So I'm talking about China. What is your take on the latest China's earnings season so far?
Yeah, we are overweight China within Asia ex Japan equities, and within China, we prefer technology, communication services, and consumer discretionary sectors. China's Q3 2025 results have been broadly resilient, and out of the 458 MSCI China index constituents, we've seen 401 reported as of the 6th of November, and they're delivering aggregate earnings growth of 12% and led by sectors such as technology, materials, and financials. And this is according to the source at Bloomberg. We remain overweight Chinese equities relative to Asia ex Japan. Valuations continue to be attractive, with MSCI China's 12-month forward PE trading at a 12% discount to the regional index. The consensus EPS growth for China in 2025 was revised down in recent months and currently hovers near 1%, but we expect it to recover to over 14% in 2026. So key catalysts here could include a potential rebound in services consumption and progress towards technological self-reliance, which is emphasized in the new 5-year plan. We remain constructive on consumer discretionary, technology, and communication services sectors, supported by sustained investment in innovation and industrial upgrades. And the trade truce between the US and China further boosts investor sentiment, while potential monetary easing by the PBOC will provide support for high dividend, state-owned enterprise stocks from the non-financial sectors.
Thanks, Fook Hien. Let's move on to the fixed income and also FX. And I wanted to check in particular to the UK. With the 10-year UK government bond yields slumping to a year-to-date low, obviously there was some rebound from the low. Is there more near-term upside in the UK government bonds? And also, what is our view on the sterling?
Yeah, we have closed our bullish opportunistic view on the UK government bonds, and we expect a potential rebound in yields. And as for the sterling pound to the US dollar, we see that in a tight range with a bullish short-term bias. So the markets have been bringing forward expectations for a Bank of England or BOE rate cuts as the headline inflation continues to ease and growth data softened. This led to the recent declines in the 10-year gilt yields to a year-to-date low of 4.37%. However, yields have since retraced slightly higher to the 4.4 to 4.5% level following stronger than expected services activity and underlying wage pressures. Within the BOE, with the BOE maintaining rates at its November meeting, the BOE is likely to move gradually on easing, tempering expectations of rapid rate cuts. So looking ahead, fiscal uncertainty ahead of the upcoming budget and questions around the UK debt trajectory could lead to a rebound in yields. Hence, we closed our bullish opportunistic idea on the UK government bonds on the 23rd of October. While lower policy rates are generally negative for a currency as they reduce investor demand, the markets have already priced in the expected rate cuts by the BOE. Moreover, the BOE's projected terminal rate remains one of the highest amongst the G10 central banks, and this is supporting the pound's appeal from a carry perspective and making short positions relatively expensive. Although the recent momentum continues to favor the US dollar, the sterling pound to the US dollar appears technically oversold, leaving scope for a short-term corrective rebound. So we see the significant resistance around 1.35, and beyond this level, ongoing fiscal headwinds are likely to cap upside to the pound to the dollar, and the investors will be closely watching the UK autumn budget on the 26th of November.
Thank you, Fook Hien. That's all the time we have for this episode, and thank you for all listening in. Please do stay tuned to our next episode of Through the Noise, and goodbye from us.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.